Okay, so tonight's webinar topic is diversification versus concentration. What's your take? Okay, so during this pandemic, we noticed that there are so many investment webinar or even some investment platform just like suddenly coming out. But as for MCM GIC, if you follow through our event, you will notice that, okay, MCM have been organizing so many webinars even before the COVID-19 pandemic. Okay, so it is a mission of MCM GIC to provide a reliable investment education platform to all the people. So ever since the MCO started last year, where people started to realize the importance of financial management, MCM has also taken the initiative to organize many webinars to educate the public in terms of financial literacy. You know, not only to the individual together, in fact, together with our business, our MCM partner Money Compass, MCM actually has organized many online events to help the SME, to help the university student, etc. So personally, I have learned a lot from all these webinars. Okay, all right. So before we start our webinar, let me go through some disclaimer. We are not investment guru. Okay, so we are global investor, and we are here not to teach you or to sell you anything. Okay, we are just here to share with you our knowledge, investment knowledge. So just sit back and relax. Okay, so the content of this presentation does not reflect the official opinion of Max Capital Management Holding. The responsibilities for the information shared in the present presentation lies entirely with the speaker. Okay, so always bear in mind that we are responsible for our investment. And last but not least, in order to have a smoother event, please mute your handphone throughout the webinar. Thank you for your cooperation. All right, okay, we have come to the highlight of tonight. Okay, so tonight's topic is diversification or concentration. Okay, this is the topic actually, or especially for the investor, we're always a bit confused whether shall I diversify my investment or not. Okay, what's your take? Today we have invited a very experienced speaker to share with us on this topic. He is MCM Chief Marketing Officer. Okay, so let's give a virtual clap to our speaker tonight, Mr. Roy Ong. Okay, Roy, I pass the time to you.
Hi, everyone. I thank you, Arthur, for the introduction, and very nice to actually meet up with every one of you. So thanks for supporting again. And let us start our topic today. Hi. Okay, let us start our topic today is diversification and concentration. This will be very interesting topic for tonight because I believe that if let's say you are a serious investor, you must have to understand what is about the diversification strategy and what is about the concentration strategy. For example, some of the investor, I think most of us always hear about this diversification because you need to diversify to reduce your risk, because we always say that Warren Buffett say the first rule of thumb is do not lose your fund, do not lose your capital. So that's why since the early time when we start investing, a lot of people already preach this kind of a concept, diversification. But we'll see that there's another group of people always focus on concentration, means that you only focus on the whatever thing that you are familiar with, maybe just a small portfolio that you want to focus, and then go full force to actually look at this thing. So there's a saying says that don't put the eggs into one basket, but another school of thought says that don't put too many eggs in one basket, or maybe too many baskets. Right, so this is two different school of thought that we would like to actually clarify today. Of course, most of the thing I want to share with you is about the diversification. When we talk about the diversification, we always say this: diversification is for those who want to reduce the risk. That's why we diversify. But the concentration is those who want to start to actually grow their wealth in a quicker way. Then they start to focus on concentration. There's no right or wrong. But okay, now I would like to know in the in the Zoom or on the Facebook. We have friends on the Facebook. Maybe can you actually let me know what is the strategy you like most? Like Zoom, maybe can we set up a poll here? Okay, so from the poll, you please click which strategy you like in the Zoom. And in Facebook, maybe you can actually type, if let's say you like diversification, you just type D. Or if you think that concentration is the best, then you type C. So that you actually later, when I talk about the D or C, the diversification or concentration, you'll start to understand yourself more. Wow, wow. Okay, quite surprised me. I think 100% of the room members actually choose for diversification. Okay, now we have starting to have 5% of us actually choose concentration. Wow, okay, even in the Facebook, we will see the majority of us actually selecting the diversification. So that's the what happening right now in the market. You will see that lots of the people will choose about using the diversification. Okay, let us, is there any other selection, any option? If not, I will go to the next slide. So we will talk about this topic. So I will end the poll now. Okay, so the result is a 96%. Diversification and 95% and 5% is concentration. All right, so there's no right or wrong. Actually, it really depends on what is the thing you want to achieve. But before we start, maybe we want to talk a little bit of the details of the diversification and also the concentration. Before that, then only we'll actually investigate whether at this current point of time, whether our strategy is practical or not, or is it aligned with our financial goal. All right. By the way, I need to set a disclaimer again, says a disclaimer again, I'm not the investment guru. I just tell you what actually these financial gurus, the investment gurus, how they think about this and why they come up with this kind of a concept. And I noticed that a lot of people, they also misunderstand why we actually want to do the diversification. All right, the first of all is about this guy, 𝐃𝐤𝐯𝐿. He is the Nobel Prize winner, and he actually come out with this, we call it as a modern portfolio theory during 1952. Actually, why he come out with this portfolio theory is because during that time in 1952, lots of people out there, when they invest, they don't really go and analyze whether their strategy is the right strategy or not. They just based on whatever they have, because during that time the information is very little. So they start to actually invest, but they don't know how to judge whether in long run, for example, in 10 years, whether they use the diversification, whether this strategy is good for them or not. That's why when this 𝐃𝐤𝐯𝐿, when he talked about the diversification during that time, is a very big topic. It's a topic that people never heard before. And then since then, a lot of people start to talk about the diversification. And what he says is, investors will favor a portfolio with a lower risk level over a higher risk level for some level of return, because this is a general kind of phenomenon in the market, because most of the investors will actually try to avoid those high risk kind of condition, but they also want to have the same return based on what they do. So during that time, this modern portfolio theory plays very well, because it actually can give you the facts, they can give you the analytics, they can give you the data to prove that this diversification is the best during that time. And especially during those times, the Wall Street people, because they don't have any tools to show to their clients, and then they are the fund managers. When this concept come out, they actually use this as a tool to actually start to talk to their clients. Says that you have to actually put yourself into a group of a portfolio in order to increase your chance of winning. So that's the basic background of why we call it as diversification. And next, when we go forward to see when the diversification plays a role, you'll see that it actually plays a role when there's a risk attached to whatever we increase. The more risk happens, the more important the diversification happens. So this one is the first thing that I would like every one of you online to understand. When the risk become more, the diversification become more important. Right? For example, like the A, you have this is Mr. A. He has 100 ringgit, and then if it says he consistently can make his return 20% every year consistently. At the year 4, he can actually double up his capital already. It's provided that there's no risk involved, there's no uncertainty involved, and every year he actually consistently make 20%. So in this case, he don't need diversification at all, because he just can actually focus one project and he can continue do it again and again and again and actually expect the same result. But we know that when we talk about the investment, there's no such thing as a perfect circumstances that nothing happened, right? So this is Mr. B. Actually, Mr. B also actually invests in the certain project, and then the project give him 20% consistent return every year. But 1 year, the third year, his portfolio actually faced a big loss, 20% of a loss. So I do a calculation based on this, only one loss, but the rest of the year he actually enjoyed the 20% consistent return. Even until up to 6 years, he still cannot reach the 100% return, means that double up his capital. So with just one loss, it takes more than 6 years to double his capital. So that's the thing that the investors, the savvy investors starts to ponder. It says that if let's say this is a case, I need to think of a way to actually protect my wealth. While growing my wealth, I need to do something in order to enjoy the benefits, but at the same time, I reduce the risk. What the diversification means that he wants to actually enjoy the compounding. That's why you see my case study is about compounding. He wants to enjoy the compounding, but at the same time, I don't want the compounding reversely actually take advantage on me. Because compounding, if let's say you use it for your own advantage, actually it can grow your wealth. But if the compounding itself actually do it reversely to you yourself, your wealth will actually reduce very significantly. So that's why Mr. C, what he do is he separate it into the two categories. The first category is 50 ringgit, second category is 50 ringgit. And throughout the 5 years, he also still faced one time of the losses, also 20%. It's happened just exactly like what happened just now to the Mr. B. But because he separate this into the two categories, he will actually sees that his loss will still let him to take lesser than 5 years to double up. So you will see that it significantly reduce the risk that he faced in order for him to grow the wealth. So that's the theory of the diversification. Okay, case study number 2. If let's say today you are actually quite positive, you are actually looking into the semiconductor industry, or maybe some of you actually from the semiconductor industry, your job nature is in semiconductor industry, and then you know that this semiconductor industry will be actually growing for the next 5 years. So you want to actually invest in the semiconductor industry, but the issue is you have limited fund. You can either actually invest everything, all your money into the company A, and hoping that 5 years later this company grow and then you can make a lot of money from that. But what if, let's say, there's so many company in the market, but I invest in the company A, but so bad luck that I have, the company A actually closed down due to certain reasons, whatever reasons that unforeseen, then you lose all your money. So that's why there is some of the financial products in the market, or some of the asset type in the market that allows you to actually invest in a basket of all these company in semiconductor industry. So they do not require you to have a lot of money or a lot of huge capital in order to invest in everything in this basket. So that your risk will reduce, but at the same time you still enjoy benefiting from the growth of this semiconductor industry. So that's a diversification, which commonly we talk about. That's why we like the diversification. Okay, now I believe that a lot of you who choose diversification, you definitely know this is a benefit. Now I would like to talk about why concentration is the thing that some of the investment guru would like to talk about. You'll notice that Warren Buffett, in a lot of his interview, he always says this. He says that diversification may preserve wealth, but concentration builds wealth. So he is a strong believer of a concentration. But don't get me wrong, when he talked about this concentration, it doesn't mean that he only invests in the 2 to 3 companies, of course. But he actually believes in focusing on those companies that actually will bring him the most growth. That's why he invests. He is a value investor. He knows this company is growing very well. He buys it at the lowest price. Then he waits until 10 years later, 20 years later, he sees the result later part, at the later part of the time. Okay, so this is the first thing he wants to say. Second thing is a wide diversification is only required when the investors do not understand what they are doing. Okay, let us come back to the just now, many of us, when we choose the diversification. For example, today you invest in the fund. The fund itself is for those who don't have the time, but they want to diversify. So the fund itself have a nature that it will reduce the risk. Of course, there's a lot of different type of funds. Some of the fund is a high risk fund, but most of the fund in the market actually is a low risk fund. They do not require you to understand how the funds works, but at the same time, they do not require you to actually do the analysis or analytic of each and every company that this fund invested in. So when we talk about the wide diversification is only required when the investor do not understand what they are doing, actually he is also referring to those kind of funds. So that's why at the start, at the beginning, I say that there's no right or wrong. If you think that you are too busy, you want to actually let other people to manage your capital, you can actually look into the funds that actually help you to grow your wealth. So that's the main thing that I want to share. But Warren Buffett, he himself, he's an expert in investing. He knows how to do the due diligence. He knows how to actually analyze the company itself. So he actually want to make a decision by he himself. Okay, he want to make a decision by he himself. So he actually invested only in the company he understand. So some people says that if those company is too so-called too advanced, too canggih, then Warren Buffett don't invest. No, it's not like this. What he means is he will actually spend all of his effort to analyze that company, but he won't actually invest in those companies which he don't understand. Is it means that he really don't understand? Not really. What he means is he don't have the time to investigate every company in the market. He will choose those companies he actually filter off using some technical analysis. Then based on his analysis, then he will start to dig all the information based on his understanding. Then if let's say he think that he really understand inside out of the company, then he will start to invest. And this is an example of his investment. He first invested the American Express, we call it as Amex, in 1994. And during this period of time, he just wait there. He don't really trade it. He just sit there and just monitor. And just out of this under 30 years, I think 27 years, right? He actually earns roughly 25 billion. And we based on the CAGR, which is 11.57%. So this is considered tremendous. Some people will say that every year you earn 11.57%. This is really very low. But you have to understand that this one including those years that this company they actually have some losses. They have some losses. But if I say you take into that consideration, CAGR, the compounded average growth rate is 11.57%. This is considered very, very good. So that's what he believed in, and he proved that his concept is right. Okay, this is concentration. And also you'll be more convinced that he is the strong believer of concentration is because out of a portfolio, this is the latest news, this is the latest information that I got from the NASDAQ. He actually invested more than 85% of his portfolio in only 10 companies. So you see that if you say that he actually is totally not the believer of the diversification, it's not really, because you still see that there is some, we call it some of the some of the way he actually diversify. For example, he diversified it into the category he liked. For example, Apple consumer product is he take Apple as a consumer product. He don't treat it as a technology, although Apple is a technology company, but it's a consumer product. But you will see that he also strongly investing in the financial company. For example, Bank of America, US Bank Corp, American Express, and Moody's. And even you see that American Express itself and Moody's itself is a very old company. And Moody's, how they make the money is because they have one company under them is doing the rating, doing the business analytics, and then they charge people based on their service. So that is a very traditional business since the Wall Street is there. This company is already doing all this kind of thing. And he invests in the company like the Coca-Cola, which everyone knows it. I don't need to explain to you what is Coca-Cola, but they already know what is it all about. And also Davita. Okay, this one. Davita is the kidney care healthcare company. It actually provide the healthcare service for those kidney failure patients. So this is also one of the area that actually is happening right now in the US. That a lot of people need this kind of a service. So basically, we'll come across with all this portfolio that Warren Buffett, when they invest in it, you already know that what this company actually is doing, because this is a big brand. Even Davita is in Malaysia. They have a company in Malaysia. So this is a very huge company that they actually goes into it. Okay, now I want to talk about something which is very, very different, because it's not right for us to just choose either I want to go for diversification or I just want to go 100% to concentration, because there's always a gray area that we want to practice. Because if today I let you follow exactly what Warren Buffett is doing, I'm sure that you can't make much money because you are not Warren Buffett, due to a lot of things that we are different from Warren Buffett. Okay, so this this James Tobin, he's also another Nobel Prize winner on the 1981 in economics. He is also the one who actually founded the theory of a modern portfolio theory together with 𝐃𝐤𝐯𝐞, just now the first gentleman there. He actually come up with this investment model together with 𝐃𝐤𝐯𝐶. But his opinion about the portfolio itself is a bit different. He says that the most efficient portfolio is a globally diversified portfolio that sits at the optimum point of the coefficient frontier. What it means that out of this diversification, he still focused on the certain area that he thinks that is the part will generate the wealth. And he actually referring this strategy to those common market, what is happening in the market. And he actually based on that kind of a concept to create this kind of a model. This will be more suitable to common people like us. I will explain why later. And of course, in MCM, Max Capital Management, we always say that diversification in terms of a globalization, you have to have a globalization view. Just for example, I think this morning, DBS just talked about something which is not a good news to Malaysian, which ringgit Malaysia right now is the cheapest currency amongst the whole Asia. So if let's say you actually investing whatever things fully in Malaysia only, you'll see that you cannot hedge against the currency. But if today you are seeing the things in the globalized perspective, you invest something in the US, you invest something in Singapore dollar, actually this kind of difference will actually make you grow your wealth, even though maybe the something that you invest doesn't grow well, but the currency itself will already make you grow your wealth significantly without doing anything. So this is what Mr. James Tobin actually want to actually share with us, is about the financial market. You need to actually understand what is happening in the market in order for you to make an investment decision. This is the first thing. Just for example, I give you a very simple example that most of the people who invest will know this. Like for example, today we are talking about the bond market. When the yield actually drops, you will see that a lot of savvy investors will actually take out their funds and invest in the equity. So you see that this is the very common phenomenon that is actually keep on happening for the past 50 years or even 100 years. So you see, if let's say today you know how the market works, then you actually know how to actually, based on this, you invest in the right portfolio that you actually understand. Of course, you have to first understand it, then only you can invest. If you don't understand the relation between the bonds and the equity market, then you can't do anything. Like for example, like last year, the US government actually launched the QE4 with USD 4 trillion. So when they launched this, a lot of us already know what will happen next. We will see that the equity market will actually grow because the QE4 actually is printing money. Then where this money goes to, it goes to the bond market, it goes to the equity market, and it will actually make the whole market actually become very dynamic, and it will grow. So what happened is you'll see that throughout last year until now, you'll see that actually it's an inflated market in the equity, especially even in the what called the startup industry, including those unicorns. You see that just last year until now alone, there's more than 100 unicorns actually coming up. One unicorn means that it's at least valuation of 1 billion. Where does this money come from? So you have to think of all these financial markets, how it works and how it actually affects the investments that we have. Okay, next. This is another thing that we'll see. That's why James Tobin actually says that you have to choose the right portfolio at the point which is most efficient. For example, if let's say you diversify, because everyone talk about the diversify, but when you choose the wrong diversification, it doesn't really actually helps you to preserve your wealth, but it actually will reduce your wealth as well. Okay, so now let us come back to this diversification and concentration, these two strategies. So now, since that we already know these two very basic concepts, then which one do you think that you want to actually go into? Let me talk about the more detailed style. Actually, the investment that we want to follow actually is based on the diversification and the concentration. There's a lot of different type of a gray area in between, and there's a lot of factor you have to factor in before you actually make the decision. Okay, I'm not advising you, but all this concept is already ready there in the market that the investment guru actually is talking about. Like the Phillips Fisher, he's actually the concentration type of a people. The Benjamin Graham concentration type of a people. But we see that a lots of company like the funds manager, they are diversification type of a people. Just now the markup. COVID is a diversification type of people. So different people, they have a different point of view. But everything actually boils down to these three things that you need to ask yourself. Because you may think everyone says that diversification is the best, but suddenly you find out that diversification doesn't really actually suit to your strategy. It may actually goes against what you want to do. What is your financial goal? First is the risk. Why the Warren Buffett would like to go for the concentration is because most of his, I think majority of his investment is in US. US stock market is a very mature market. It's considered one of most mature and most stable market in the world that I can say. Of course, you compare to a lot of other country, is quite stable. So because of that, the systemic risk that Warren Buffett faced will be lesser. So for him, he will actually focusing not about the risk. He will focusing about the company's fundamental, about the companies, whether the value itself is low enough for him to actually grab it, whether this company have a future for the next 10 years is still growing. So that's his concern. That's why the risk itself is one of the things you need to actually always ask. If today you invest a lot in the property, or today you invest a lot in the private equity is considered a higher risk. So you may have to think of how to actually diversify it. But if you're investing in the, for example, bonds, not much risk that we are talking about. Why you want to diversify in the bonds? It doesn't need to do so. So you can actually just focus on that area only. Okay, and bonds is for you to preserve wealth. This is what we mentioned just now in the earlier slides. We already mentioned that. The second thing is a asset class. What kind of asset that you are investing in? You are investing in the bonds, you're investing in the properties, or maybe the fixed deposit, or maybe in the equity. So all these also will determine whether you want to actually diversify or not. Okay, the third part is the most crucial part, which I want to tell. This is also the last slide I want to tell, but this is the most important of the session for today. The ability itself also will actually let you have to think whether you want to go for diversification or concentration. Warren Buffett, any one of you think that you are better than him in terms of investment availability in Facebook or in Zoom? Any one of you think that you are better than him in terms of ability? I believe that most of us think that he has the superb ability when it comes to the investment. So if, let's say, you know that your availability of the investment is strong enough, so you would like to do the concentration, because concentration is more like attacking, because he has the ability to reduce his risk, not about the market risk, but he himself, the investment strategy risk. He still lose money. Of course, everyone knows that last year he actually lose money from investing in the aviation company, in the airline company. He still lose money, but most of the time he actually will make profit from other company. So his ability is already proven. But if, let's say, today we are new to the market, we are the newbies, we start to invest, of course it's not advisable for you to actually invest everything into one project, unless that you really know everything about that project. Maybe that's something you might want to consider. If not, then maybe you have to take a balance in between. Part of your capital, maybe you can actually go for those diversification type of investment, but another part, maybe you would like to actually invest in something you really believe in it. But when it comes to the ability, I always believe that knowledge is a power. Knowledge is the thing that you accumulate based on what you are doing. And so far I see that in the market itself, most of a very successful investor, they will believe in concentration because they believe in their ability and they believe in how they actually can get the most out of a thing. But of course, you won't actually find any investor, the guru, the famous investment guru, that only invest in one or two company. Normally, they'll have at least 10 company or maybe at most 20 company. He won't actually spend too much of time to keep on analyzing. He will pick the most proper company he thinks is the best, then he actually invests in it. That's why his partner, Charlie Munger, tell this. That's one of his quotes say, if today you are an active investor, you are the same investor, you really know what you are doing, then if I remove the top 10 investment portfolio from your portfolio, you feel like you are nothing, because actually the most fruits that actually give you the return actually is come out from the investment that you put most of the effort there. All right. So the last but not least is to talk about the fundamental that you have to lay, because all these three factors that affect you, always we have to ask ourselves, what is your financial goal? Why you want to invest? You want to invest because you want to preserve your wealth, because maybe you are going to retire. That's why you want to preserve the wealth.
Right.
All right, this is almost end.
Okay.
And you want to grow your wealth, or maybe you have your own financial goal, or maybe sometimes you invest because you just want to do a tax planning only, because some of investment can actually let you have the tax planning, or sometimes you want to actually from the company point of view, we want to expand your business, so you invest in some other company, or maybe you want to venture into the new industry, so you actually start to invest in that industry in order to actually have some control in that market. Or maybe some of our people want to have a higher return, so they invest in certain projects that is highly volatile. It will give you a very high returns. All this, you have to acquire your knowledge first before you actually make a decision. So this is a book that the MCM actually launched, the second book, which is one of a very important book in my life. Of course, the first version that actually I read this book, actually it broadened my mind to talk about the global investment, to talk about the global strategy, that actually when we goes into a certain investment, there's a lot of a strategy that we can use. And this book is the second version of it, that it will talk about not only the real estate, but it will talk about a lot of the strategy in the book, in the business. And those concepts that I mentioned just now, the diversification, how to actually invest through the 3S, the 3 keys, and how to actually invest using the business investment life cycle, all these actually are in this book. So if let's say you are really serious in your investment journey, I encourage you to actually get this book and then start reading it by today, and you will see a lot of things differently. So that's my sharing for today. Thank you very much. I pass over to Arthur.
Okay, thank you, Roy. Okay, I think we really learned a lot, because all the while we are talking about, we are just talking about we need to diversify in our investment. But in fact, after listening to Roy's sharing, when we talk about diversification, there are so many angles that we need to consider. Okay, so thank you very much for Roy sharing.